Well, at 1031 Financial, we help investors navigate the problems that commonly occur during a 1031 exchange. And we do this by leveraging an investment vehicle, a fractional real estate investment vehicle that's contained in a DST wrapper, a Delaware Statutory Trust. So by leveraging these DSTs, both standard DSTs and specialty DSTs, usually we can help fix or accommodate an investor's goals when it comes to selling their investment real estate and coming up with a replacement property or a replacement portfolio. So to give you an idea, we work with about 40 different sponsors. And at any given time, we have about 80 to 90 different replacement properties already pre-vetted, already ready to be invested at any time. So a lot of times when investors have problems finding a replacement property, or let's say doing the due diligence on the property and they find that there's some environmental issues, all of our properties are already pre-vetted and ready to go. And within these 80 to 90 properties, we have student housing, different asset classes. We've got self-storage. We've got industrial. We've got Class A multifamily. We got senior care facilities, senior facilities. So depending on what the investor's goals are, not only can we create a diversified portfolio by asset class, right? But we can also diversify that individual geographically. And then on top of that, some of our products have different targeted hold periods. So typically, 95% of our products is built to go 10 years with a targeted to go full cycle after 5 years. But we also have some land deals that have a 2, 3, and 4-year target. So now think like staggered CDs with different maturity dates. Not only are we going to diversify the client, let's say in an example of $1.5 million, putting them into 5 separate investments of $300,000 each, but now 2 or 3, well, let's go with 1. 1 to 2 will have a 3-year target, 4-year target, with the other 3 having a 5-year target. So now, if our client has a change of economic circumstance, some of the money will be rolling over in just a 3-year holding period. So when they reach that 3rd year and they don't need the funds for something else, they can reinvest into a typical 5-year hold. That kind of goes to the back of the line, right? And now they're going to have another liquidity event in 15 months or 2 years. So now we create a portfolio where they're getting their estimated 5, 6, 7% rate of return, but also some of their money will keep becoming available. So depending on what the client needs, we have the products to either go into one investment. Sometimes we'll have an investor come to us and say, I was hoping to buy this facility for $5 million, but I don't feel good about the market right now and the price. Well, we'll take those shorter duration products. And if the client has enough other assets, right, they can buy one. They can go, $5 million into the 3-year targeted hold, right? They get their, as I like to say, their consolation prize. They're clipping a 7% coupon, right? And then in 3 years, they're going to have a liquidity event, and they'll get another shot at getting back into the market and buying what they originally wanted. And then we've got products that have a refinance option. So let's say somebody comes to me and says, hey, Scott, I've been real estate rich, but cash poor. And I don't have any reserves. And I'm very concerned going into retirement, having a certain amount of liquidity, but I don't want to pay tax either. I don't want to give up that principal and chip out my heirs. So what do? We've got some DSTs where they can go in, let's say an example, $1 million out of their $5 million investment. They put $1 million into one of the DSTs that have a refi option. They can wait 30 days. They can wait till the next tax year. They can wait until they need it. But they can trigger the refi, let's say in this one product that we have available today, where it's got a 85% refi option. So on $1 million, they can pull out $850,000. They can put that money into a money market, into a stock portfolio. They now have the liquidity that they were looking for. Now on the refi, it's a 20-year interest-only loan, coterminous with the 20-year lease with the tenant. Usually these are very large, well-recognized, publicly traded companies that are the tenants. So the lenders feel really good about the money. They're willing to lend at a really aggressive rate. It's good for the client, 20-year interest-only loan. But the beauty here is that the sponsor is diverting the rents and making the payments on behalf of the investor. So literally it becomes a turnkey loan. Now the investor still owns $1 million in that investment. So even though they're not receiving any more monthly income, what are we hoping for? We're hoping for the same thing that happened in the last 20 years, appreciation in real estate. So at the end of the 20-year hold, they're going to sell the property. So let's even go with the fact that there's no appreciation and the property sells for the same amount. So in 20 years from now, they've had use of the $850,000. If they didn't need it for any emergency issues, maybe that money grew in their stock portfolio. Maybe they invested, said, hey, I don't need that much. They invested some back in real estate. But hopefully that 85% grew. But when they sell the property, they're going to pay off the $850,000 mortgage, and they're going to get the other $150,000 that was sitting there in equity. That goes to the QI. And now they have to buy another $1 million of real estate. We have products today where if someone said, hey, Scott, I got to buy $1 million, I got $150,000, do you have something for me? And the answer is going to be yes. So our motto is to help the investor achieve their goals. Don't pay a tax today. Always defer the tax. Defer, defer, defer. Die, get the step up in cost basis as part of your estate planning. So we're here to help. So if you like this video, hit like and subscribe, and have a great day and continue to defer those taxes.
Can you do me one quick favor?
Yeah?
Into the camera that's over Seth's shoulder.
Yeah?
Look into that one and just give me your name and a little bit of your bio. And try to drag this on for 3 minutes.
Oh, okay. Okay, you got it.
You want to start with timer so you can see it? So just your bio. By the way, I don't know you, so I want to know you.
Oh, okay.
I want to look at the camera.
Okay, so my name is Scott Offerman. I'm with a firm called 1031 Financial. In my life, I've done a lot of things. I've had startup technology companies. I've been in the family business, which was paint manufacturing. Went to college at Tulane University. Got to say it correctly, Tulane. After my second technology startup company, I went into the financial industry. I started working with Mass Mutual, doing estate planning, insurance planning. One of my clients, one of my most stubborn clients, happens to be my father. He had been in the paint manufacturing business for years. He sold his book of business to a competitor, Mercury Paint in Brooklyn. It was a good sale for him. He then started leasing out the 40,000 square feet of industrial space in the Bronx, along with 30,000 square feet of yard space. And in a short time, my father found out that he was not a very good landlord. And my recommendation to my father was to go ahead and sell his investment property. But he had an objection. He said, Scott, that's great. I'm going to get a good price for this property, but I got to pay tax. And I said, well, Dad, you don't have to pay tax. I heard something about a 1031 exchange. So I found the buyer for my father, self-storage company. They came in. It took about a year and a half for them to iron out and negotiate all the details. In the meantime, I started researching because when my father said, okay, that's great, we can defer it, but then I have to go out and buy something, I said, well, let me look into it, Dad. And we discovered the Delaware Statutory Trust, the fractional real estate. And so I investigated the DST market for 6 months. I moved my practice over to a broker-dealer that carried Delaware Statutory Trusts. My father moved ahead with his 1031 exchange. We purchased 6 different DSTs. Our joke now in the household is that my father is a great landlord because now he no longer manages investment real estate. All he does is receive a check. And when the DSTs roll over, he and I work together on selecting the new DST to go into. And that's kind of how I started in the DST business. Since then, I've worked with a lot of real estate attorneys, qualified intermediaries with their clients, different investment strategies. I've had clients where they were in partnerships. Partnerships are like marriages. Sometimes they work, sometimes they don't. I had a group, 3 family members in an S corp where basically one of the siblings wanted out. We structured it so that the S corp went into a buy-sell agreement with one of the siblings. They moved ahead with the 1031 exchange. They took a third of the proceeds, went into one of the Refi DSTs. 30 days after they finished their 1031 exchange, the S corp triggered the buy-sell agreement. They then triggered the refi. They used the refi to fund the buy-sell agreement. That one sibling paid their tax, and the other 2 siblings and the S corp had a full 1031 exchange. So we like problems. We like problems that happen during a 1031 exchange. We like to help out with those problems. We like to consider ourselves very creative in terms of helping the investor realize their goals, to defer that tax. I believe that every investor has the right to defer those taxes and as part of their estate planning, leverage the tax code, get that step up in cost basis, leave your heirs with the wealth that these investors work so hard in accumulating during their working years. So many of our clients are able to execute on those strategies, provide monthly income through their retirement, and then provide a nice present, a nice asset. They present their wealth to their heirs without the detrimental effects of paying tax on capital gains and depreciation recapture. So my name, once again, is Scott Offerman. So if you like this video, hit like and subscribe and keep deferring those taxes.